Well, thank you everyone for joining us. We're just having a quick chat today about what is credit enhancement. I'm Amy Antczak. I'm General Counsel at Energetic Capital. I'm joined here today by Nathan Maggiotto, SVP of Strategy and Business Development at Energetic Capital, and Eric Popien, Executive Director leading the Energy and Infrastructure Practice at Antczak Global Risk. So let's get into it. The topic of this chat today is credit enhancement, but I would guess that most people don't automatically think about insurance when they think about the term credit enhancement. So explain to us, why are we here talking about insurance today?
Yeah, I can jump in with that one. When I think about insurance, I think about risk. And when I think about credit, I think about risk. So credit, when I'm extending credit to you or to anybody, I am taking a bet on them and their future performance of an obligation. We think of that most often in terms of payment on a credit card. The credit card company is taking a risk that you are going to pay them back for the amount that you borrow when you make payments on that credit card. So when you think about credit and risk as kind of very similar things, it forces you to think about insurance, because in order to reduce risk and make it easier to extend credit, you need to remove or reduce the risk. Insurance does that. And so when I think about credit enhancement, I think about insurance, and it's not just your ability to pay in kind of the traditional sense of my credit rating, but things like property policies covering hail damage on solar panels, or everybody's home. If you own a home, your mortgage lender requires that you have a homeowner's policy covering damage to your home. That's a credit enhancement on the, benefiting the mortgage lender. So I think that the two are inextricably tied. It's just one of those things that it's like insurance in some ways is so ubiquitous, you don't think about it specifically. And it's only when you get into some of these more specialist or niche classes that it starts to be a little bit more explicit, and you have to force yourself to intentionally think about insurance in that way, which is why it's great to have Eric here, because I think in the transactional liability world, it's it's all allocation of risk.
Yeah, that's exactly right. And when I'm thinking of anything in the energy space or project finance more broadly, you're thinking about not maybe what you've already taken out from debt like a credit card, but I'm thinking about the ability of the project to generate revenue and cash flows into the future. And you're right, there's a trade-off in risk that you're making as a finance professional investing in a project, as a developer of a project, and as maybe a tax equity investor in these projects. And there's always a natural misalignment in the concept of risk, depending on what their portion of exposure is on a project and what their exposure might be outside of a particular project, looking more globally at their book. And the other aspect of kind of why insurance the clients think about is folks that are making these investments are often thinking of how do I reduce my risk? How do I create a floor and just focus on creating more upside opportunity, giving them the ability to sleep at night, but also the ability to get their partners at the table in a way that is going to be advantageous. So you're looking at alternatives. Some might look into the securities market. You might look into finding a banking partner or maybe upsize their debt so you can have less equity on the table, or vice versa. The insurance component is particularly interesting because you have a party that is well suited from a knowledge perspective to be able to take on risk. That is what the entire world of underwriting is about. But you also have someone who has typically the lowest cost of capital, which makes it much more financially competitive and a very good partner in most situations to transfer risk to that market rather than to another commercial party.
Yeah, that's great. I mean, just to summarize what I think has just been said, insurance is really a mechanism to transfer risk or reduce risk. And so when we're thinking about credit enhancement, insurance is a great way for that risk to be mitigated, to be transferred, to be reduced. So risk is really what we're talking about here. And I want to go back to something that you mentioned, Nathan. You talked about your homeowner's insurance that you need to get a mortgage. And so that makes me think that insurance is something, I think most people think about it as a requirement, something that they're required to get, say, when they're buying a house. In order to get their mortgage, they need to buy homeowner's insurance. If they want to drive their car, they have to get auto liability insurance. It's a requirement. They can't do these things without it, and it's probably not something that people are happily purchasing sometimes. But so I think insurance has this reputation amongst most people as a reactive product. They're buying it because they're required, and they're not really thinking about the insurance until something goes wrong. They need to file a claim and they need to get paid back. But insurance can actually be used proactively to facilitate innovation, especially in terms of climate risks and resiliency. And so I'm asking you both, how should we really be thinking about insurance with respect to the green transition?
Yeah, one thing I think about, the reactive elements are, I mean, insurance, the vast majority of insurance is reactive, and it should be, right? It's meant to transfer the risk of damage from people who can't afford it to a large aggregator of exposure who can afford it. And that's super important. I try to think of insurance as a mechanism to compel action on the part of an investor. And the example that I often think about from my own experiences in emerging markets and the political risk insurance market, where you have a desire by companies, foreign investors, to make contributions and investments into projects or manufacturing facilities or other types of, for lack of a better word, investments. I've said that word 3 times, I think now, into these foreign markets. But it's risky, right? And it could be proximately important for them to do so because it's close to the inputs that they need for a given process, and then has good access to shipping lanes to get it, to where it needs to go. But could be in a country that is perceived to be more risky. So at first, governments took on that risk by providing political risk insurance policies. Now the private market is taking on that risk, but it removes the elements that we were giving you uncertainty in the future performance of that investment in order to compel you to take action. What has come out of that is this really interesting intersection between like catalyzing investment and kind of using insurance as a tool to go in and say, in places where I'm not getting enough investment, how can I get more investment in there? So rather than saying, I need to do this for my own good, but how can I use this tool that exists that works there to help me invest in a manufacturing facility in a risky country, to compel other investors to go and invest in other risky countries where they may not have been thinking of doing so in the past.
Yeah, kind of pull it into what we see in the current day market. You mentioned folks generally think of insurance as a garage product. They begrudgingly have to go pay for it. And they see the insurance, giving the insurance as a roadblock. They're not actually looking through to, it's the underlying risk that's a roadblock, and insurance is actually the tool. And a lot of the time that we spend with clients is educating them about the art of the possible of using insurance as a strategic tool to think of how do you achieve your goal by removing that risk or mitigating it to an extent that there's a more efficient economic outcome. And in the market today, think of things like representation warranties insurance allows sellers to get a cleaner exit and buyers to have a rated third party to claim against. So you're mitigating your credit risk and you're creating efficiency within that transaction. You see it in the tax market today, where the largest volume of tax insurance today is being deployed in respect of energy tax credits, where you have, again, a disparity in the risk profile, risk tolerance of parties. And without having that as that insurance backs up, it doesn't allow for the efficient transaction. And I'd say without it, you'd have a much slower and much smaller pool of viable projects. But you also see this now where there's still a lot of unmet need and new technologies, new geographies, and the insurance markets are very good at taking on risk. They may not move quickly, but they're good at taking time to learn about and cover off these new areas of risk, where there may not be a viable commercial party that otherwise is ready to take it on, and it will therefore extend the timeline of reaching energy transition. And I think without insurance, there's no way we hit the energy transition goals we're saying now.
There's an investment gap. How do we compel investment into the energy transition? You de-risk it, right? Let's identify the risks. Let's be surgical about it. That's the beauty of insurance. You can pick out specific risks, M&A, reps and warranties. What's the specific risk that I'm trying to think? I'm worried that they are going to breach a representation. And it could be willfully or unwillfully, right?
Correct.
Or it could be, I'm investing in this new battery plant, and I have no idea whether or not the process with which I'm using to manufacture this battery, and that this chemistry that the battery is going to deploy is going to, sufficiently achieve the energy storage and redeployment promises that it makes to customers. So how do I de-risk that? And then that's how you can compel action and get more investment in the energy transition.
Yeah, and just if I can throw a few examples into that. Technology adoption is a huge one. We have a lot of things that are very promising. You mentioned batteries, but you see it in biomass, you see it in RNG, where we understand the chemistry or some of the basic kind of, but moving those things from their initial kind of beta phase tech into a large commercial scale deployment presents a large market risk. And because of that, you might not necessarily even focus on each individual project having an issue, but if you look at banks who might be deploying a lot of capital across the portfolio, they're looking at this thematically. And they're saying, do we have the appetite to support these projects as a whole? And do we have the appetite to do it for a long period of time? And those, again, are all issues that are going to be major headwinds as we start to deploy capital in the space. And if we want to truncate that timeline, insurance seems like it sure is probably the most cost-effective method of getting there, at least today.
Right. So there's lots of really exciting things happening with innovation in decarbonization, but it's very risky. Like we said, these are new technologies. There's a lot of risk, and that's where insurance comes in. So I'm hoping we can talk just a little bit more about the role that insurance can play in encouraging development of these green technologies, and how, climate-focused insurance can be used for decarbonization, and what are the gaps in these markets, and how can insurance fill them?
I think of it in three ways. There's the technology piece, right? To your point, like if banks on a wide scale are going to lend against novel biomass technologies, they need sufficient, they don't want to take that technology risk. Someone else is better placed, has a comparative advantage to assess it and take that risk. So that's like super easy one. I think that there's an interesting one kind of in the middle, which has to do with resiliency, which is like what the insurance market broadly is super concerned about, is like, how do I reduce the losses I'm paying out as a result of climate change? And you could reward people for adopting climate forward technologies in their insurance pricing. So if you have a house and you put in certain resilient technologies that are climate forward and support the energy transition, then maybe you get a benefit, right? That's a kind of an easy, kind of carrot and stick approach that the insurers can take. And then the reason I kind of joined the climate sector is I saw the same problem that we saw in emerging markets in climate. It's like there's a really easy way to innovate and get investment into innovation, and it's by using credit insurance and other insurance tools to compel investors to finance them.
Yeah, and I think you mentioned something there that maybe gets lost among folks who aren't in the insurance world, but the concept of having the right methods to reduce your loss as an insurer actually aligns incentivize with what is best for the underlying customer. So it's getting projects back online quickly. It is find ways to reduce the overall loss and operate in a way that's going to be beneficial to all parties. We see this in the property and casualty context fairly often. There's an incentive to pay out quickly to reduce future risk, but also to deploy the right technology to reduce risk. If you've seen recently in some of the states that have a lot of hurricane exposure, you found folks were unable to get, or they had to pay extraordinary amounts out to get insurance that would actually cover their property for wind, hail, and storm surge. And what you see now is that they're adapting the actual building codes, and the insurance is ratcheting down. So if you have a more resilient roof, to use the resiliency word, you're going to get rates that will actually attract it and make it, and it'll be covered by insurance. But if you're looking back the other way, you're actually reducing the chance of a loss for the underlying projects or the individuals who have the exposure. So these things do go hand in hand.
That's great. Well, this has been really interesting. I think we've covered a lot and learned more about credit enhancement and insurance and how they can work together. If anyone has any questions after watching this video, please feel free to reach out to Nathan or myself at Energetic Capital or Eric at Atlantic Global Risk. And we'll be coming back with some more discussions about how insurance companies can work collaboratively with financial institutions to manage climate-related risks, enhance sustainability, and also increase long-term profitability. So stay tuned. Thanks for watching.